Welcome to today's Explainer. I am incredibly pumped you're here because today we are unpacking a really fascinating, fundamental tension that is completely defining Tesla in 2026. Right now, this is a company caught exactly in the middle between some absolutely staggering visionary ambition and, well, some very harsh, undeniable financial realities. So, spoiler alert, this isn't just a story about electric vehicles anymore. It's a story about a massive corporate metamorphosis. Okay, let's dive right into this. On one hand, Tesla is currently seeing their highest delivery numbers ever. I mean, they are pushing cars out the door at an unprecedented rate and just dominating the market share when it comes to sheer volume. And yet, profit margins are shrinking fast, and the stock is down roughly 27% year to date. So you really have to ask yourself, how does a globally recognized brand sell more physical products than ever before, yet make substantially less money doing it? To unpack this corporate mystery step by step, here's our roadmap for today. We'll start with 1, the financial reality. Then move into 2, the AI gamble. Look at 3, the future fleet. Assess 4, the global roadblocks. And finally weigh 5, the road ahead. Starting off with Section 1, the financial reality. Selling more, making less. To really wrap our heads around this paradox, we've got to look straight at the raw Q2 2026 numbers. Deliveries actually hit a record 480,126 vehicles, which is up 25% year over year. And because of that wild volume, total revenue beat Wall Street expectations by nearly $2.7 billion, landing at a massive $28.2 billion. But here's the catch. Look at the earnings per share. That's a huge indicator of fundamental profitability, and it came in at just 33 cents, completely missing the 54-cent consensus estimate. And the auto margin, down to 16.3% from 19.2%. Why? Well, to hit those record-breaking delivery numbers, Tesla had to aggressively slash their vehicle prices. So, long story short, the revenue engine is roaring louder than ever, but the profit engine is definitely sputtering. The wider financial picture really just adds to this strain. Operating income actually plummeted by 57%, dropping down to around $400 million. And beyond those lower vehicle prices we just talked about, operational costs are rising pretty much across the board. Plus, there was a massive 51% drop in revenue from regulatory credits. That's usually the easy money Tesla makes by selling its surplus carbon credits to other, less green automakers. When you take away that high-margin revenue, the true cost of making and selling these cars becomes painfully obvious. And here is the real gut punch. Despite all those record sales, the company reported a negative free cash flow of roughly $1.1 billion in the second quarter. In simple terms, after paying all their bills and investing back into the business, $1.1 billion physically flowed out of their bank accounts in just 3 months. That is some intense cash burn. Which naturally leads us to the core question driving today's explainer. Where exactly is all that money going? What on earth is eating up billions of dollars in hard cash while car sales are continuously breaking historic records? That brings us to Section 2, the AI gamble, Terafab, and the chip bet. Simply put, Tesla and SpaceX are going all in on artificial intelligence and absolute vertical integration. To really understand the staggering scale of this pivot, just consider the number $119 billion. Tesla has already formally committed $16.8 billion just for Phase 1 of Terafab, which is a massive semiconductor factory down in Grimes County, Texas. This is not about building cars anymore, guys. This facility is designed to build the actual computing brains required for next-generation tech. If it's fully expanded over time, this single facility could cost an astronomical $119 billion, making it one of the largest and most expensive industrial projects in human history. Elon Musk himself framed the sheer ambition of this project, saying it will be the largest and most valuable building on Earth by far. We're talking about a 100 million square foot complex. Its core purpose? To manufacture advanced AI chips for Tesla's self-driving cars, the Optimus humanoid robots, and SpaceX's space-based data centers. They basically want to control the entire technological supply chain, all the way from the initial chip design down to the final manufacturing. To really grasp what this pivot means for the company's daily financials, let's put it into a little perspective. Tesla projects their 2026 capital expenditure, meaning the money they're actively spending on buying, upgrading, and maintaining these massive physical assets, is going to exceed $25 billion. That amount is more than 6 times the company's entire annual profit. They are quite literally betting over 6 times what they make in a year on this vision of an AI-driven future. And the absolute centerpiece of this massive financial spend is their fifth-generation AI chip, known as AI-5. This is what's going to power all of their future self-driving systems. Right now, they're targeting limited production in 2026, aiming for full mass market production in 2027. Interestingly enough, Musk has actually hinted at a potential collaboration with Intel to help make this aggressive timeline a reality. For a company that violently prides itself on keeping absolutely everything in-house, reaching out to a legacy chipmaker like Intel really shows just how fast and honestly how desperately they need to scale this technology. Moving right along to Section 3, Future Fleet, Cybercab, and Autonomy. We are basically watching the entire Tesla ecosystem fundamentally mutate in real time. To shore up their present-day cash flow and, keep the lights on, they're launching a more affordable, pared-down base variant of the Model Y around August or September. But look at where they're actually headed with the Cybercab. This is a vehicle expected to cost under $30,000, featuring gull-wing doors and, get this, zero steering wheel or pedals. None. It's designed to rely entirely on cameras and AI to navigate the world. Throw in their plans for a 20-passenger autonomous robovan and the Optimus humanoid robot, and you can clearly see a company trying to transition far, far beyond traditional consumer cars. And the craziest part, this autonomous mobility model isn't just theoretical anymore. Unsupervised robotaxis are already actively navigating the streets of Austin, Miami, Orlando, and Tampa. That grand vision of owners eventually listing their autonomous vehicles on a centralized ride-hailing app to generate passive income while they sleep, it's actively being tested in major U.S. cities today. Next up, Section 4. Global roadblocks, regulatory headwinds. We do need to look objectively at the regulatory facts currently challenging this autonomous future, because the international hurdles are, they're significant. Over in Europe, authorities in Sweden and France are officially urging the EU to reject full self-driving, citing some serious speeding and driver attention concerns. Meanwhile, over in China, the demand for the physical cars remains completely massive. The Shanghai plant delivered nearly 94,000 vehicles in July alone. But without that crucial FSD approval, which is now heavily delayed to the third quarter of 2026, Tesla is essentially selling hardware without its most profitable software attached. Back home in the US, the safety scrutiny is equally intense. Tesla is currently recalling over 20,000 vehicles due to excessively bright low-beam headlights. On top of that, the National Highway Traffic Safety Administration is actively investigating approximately 1.2 million vehicles over reports of suspension failures. These aren't just minor mechanical hiccups, they are significant public relations hurdles. Because when you're asking international regulators and everyday consumers to trust you with steering wheel-less robotaxis, massive recalls for suspension failures and glaring headlight issues add a very heavy, undeniable layer of uncertainty to an already aggressive timeline. Finally, Section 5. The road ahead, Wall Street divided. Wall Street is fundamentally split right down the middle on how to view this company right now. If you're an investor, you really have to choose which of these two realities you buy into. The bull case sees a 21% upside. They're looking strictly at the long game, betting on explosive, paradigm-shifting growth from the robotics pivot, the imminent robotaxi network, and the energy storage business. But then you have the bear case. These skeptics are terrified by the ongoing strain on the company's finances caused by sustained, historically high capital spending and that billion-dollar negative cash flow we discussed earlier. So here is the question I want you to walk away with today. Tesla is clearly no longer just a car company. They are rapidly and incredibly expensively becoming an AI, robotics, and semiconductor manufacturer. But will this massive, high-stakes transformation actually pay off? Only time will tell if betting the absolute farm on AI was the greatest move in automotive history or a bridge too far. Thank you so much for joining me for this explainer. Keep questioning, keep learning, and keep exploring the fascinating intersection of business and future tech. I'll catch you next time.